Guys, and welcome back to the channel. Today we're going to share about how you as a beginner can identify companies to invest into, right? Because I know that as a retail investor, when you're starting out, there is a lot of information overloading, right? You get many sorts of different information sources like YouTube, financial articles, right? Even from school if you're a finance student. So all this information can get quite overwhelming, as I have experienced back when I first started out, right? And even more so today, where information is just a lot more abundant than before, right? So one easy way for you to identify companies to potentially invest into, and a quick way, is to use a list of companies filtered by the largest by market cap, right, and other various metrics, right? So for example, StockPenguins.com, we have a feature called Top Companies, where we have created the list of the largest companies in US by market cap, right? So this list is easy for you to pick a company to research further into and potentially invest into. Why is that so, right? So basically, it's simply because it's filtered out by the 100 most valuable companies in the US by market cap. And why is this a good place to start? Well, number one, it's safe, right? Large and proven. So all of these companies have withstood the initial stages of taking the company off, which is the most dangerous, right? So most companies do not actually succeed, and most companies actually fail after the first few years of operating in business. But these companies, right, have withstood the test of time, have grown to its size, and it's not that easy to just get disrupted and just having its entire business disrupted in a few months or even a few years, right? Some may even take decades to disrupt. So it's a very good place to start looking at companies to invest to, especially if you're looking for safer types of return and you're more protective of the downside. Number two, it's a lot more relatable, right? So many of the top companies by market cap, you have your names like your Microsoft, your Netflix, right? Your P&G, Procter & Gamble, Unilever. All these companies are very relatable. You know them, right? You probably use their products and services. So there is a form of familiarity. So it's easier for you to understand their business model and how it works. So Warren Buffett has this famous quote that he only invests in companies that hits within his circle of competence, right? So this top 100 companies by market cap provides you with a list of companies that's already very familiar to you. So it gives you a sense of competency, right? You're investing in something that you actually know, rather than you pick a company that's of way smaller market cap, but they're operating in a very intricate kind of business model or even sector that you may not have any knowledge of. So you're basically investing blind, right? And when there's big drawdowns, you wouldn't know how to react, and you wouldn't know what are the catalysts that could help the stock price recover or drive it further ahead. So actually, having a sense of familiarity and investing within a circle of competence is essential for you to maintain your whole emotional control as an investor, right? And knowing what's going to happen next and why something happened. So the companies in the top 100 market cap list is a lot more relatable in the sense, right? And number three, it's ran by seasoned executives or founders. Some of them may have still their founders on board, like for example Palantir, right? The founders are still on board. Meta, Mark Zuckerberg is still there, or either they're run by seasoned executives who have been there and done that, right? So you'll be a lot more safe in a sense when you're investing in a larger market cap company. And because these companies are large in nature, they belong in the many indices like your S&P 500, right? So a lot of these companies are policed by financial institutions, analysts, and exchange heavily, right? So you get a lot of transparency and information, right? So you do not be that wary of information not being there, like maybe they're excluding something, because a lot of these analysts are also doing the work for you to help uncover any potential catalysts or maybe even any risk of this large cap company. So a lot more work is done for you in a sense, right? And also a lot of these market cap large companies, right, especially in recent years, like companies like the Magnificent Seven, right, have outperformed the index severely over the past few years. So actually, there's this misconception that you have to invest in smaller cap companies to get outsized growth, but actually you can also do so by investing in selected large market cap companies, right? So they can outperform the index, especially if you look into some of these top companies by market cap that has a narrative that's driving the business forward. And all of this is also evident by their financials, which is all very transparent and clear, right? And lastly, right, so this list of top 100 companies gets refreshed in the sense by the market's vote, right? So weaker companies will get phased out of the top 100 market caps list, and over time, right, newer and more dominating companies will enter the list. So if you think of Palantir entering the top market cap list over the past recent years, but continue to outperform in terms of the share prices, right? So doesn't mean that a new company enters the list, it couldn't continue to outperform in terms of market cap. It can still climb the list. So that's one thing to look at, right? And those weaker companies that getting phased out of the list are usually the ones that getting disrupted over time by these new companies that are entering and dominating the industry, right? Another way to identify companies to invest in is by filtering by your valuation matrix. So StockPenguins.com, we actually allow you to filter the top companies list by by net income, PE ratio, price to book ratio, price to sales ratio, etc. Right? You can even filter it here, right? By PE ratio, some of them are loss making, but they're still in the top 100 companies list, right? PE ratio, very expensive company, DoorDash, etc. So it is a way to, in a sense, identify undervaluation by filtering from the highest to lowest valuation matrix. But a very important thing to take note is that valuation matrix will vary across different industries, right? So for example, tech may have higher valuation matrix compared to legacy industries like oil and gas or FMCG. That's because tech is a lot more fast growing, right? So a lot of people like to invest in fast growing companies, and this is the reason why its valuation matrix is a lot higher. Its market cap is a lot higher than its actual fundamentals. But for this kind of companies, I suppose it's the growth that matters, right? And also, which is why valuation matrix vary across different stages of the company, right? So for example, Palantir is fast growing, hence there's a high valuation tag to it compared to maybe Exxon, which has a still a very decent market cap. Its valuation matrix may be a lot lower because it's not growing as fast as Palantir, right? So, but regardless, right, it's a good place to start learning to analyze companies, their financials, and prospects due to the greater amount of information out there. So, these companies with top market cap, right, a lot more analysts are covering it. There's a lot more scrutiny in terms of their regulation and information transparency. It's very easy to get information, right, compared to analyzing a small cap company where information is maybe a lot more scarce. But the thing is, you also need to know the cons of investing in companies, only in companies with a large market cap, right? So, number one, it may offer lower returns, as I mentioned, because the alpha, in a sense, is more widely known by market participants out there. You have a lot of people investing in these top market cap companies, right? Your pension funds, your ETFs, right? Your nowadays, even a lot of hedge funds are just putting all their money into the Magnificent Seven, for example. So, it may offer lower returns, right? And if you are looking to just get returns that's similar to index, right? The top market cap companies may offer returns that's very akin to investing in index or ETF, especially if you are investing diversely across the top 100 market companies by market cap. So the more narrowly concentrated you are, the more the returns may not follow the index. But if you want to invest in a lot of companies and just investing in the top 100 companies list, you might as well just invest in the ETF, right? It reduces the work of managing so many companies, and you get a lot more diversity in terms of return. You get less volatility in a sense. And number three, you still need to deep dive to account for the narrative of the company, right? So some companies in the top 100 market cap could be legacy names that are getting disrupted. So you always do the work and not just rely solely on financials. The top 100 companies list is a very good way for beginners to start filtering out and learning about the whole concept of stock investing, fundamental analysis, things like that, because of the familiarity and the abundance of information of these companies, right? But over time, you still have to do the work and deep dive and finding out the narrative, whether it's getting disrupted, things like that. So you cannot just rely solely on the financials, and you always have to do the work and to learn. So that's all for today. Thank you.